With me now to talk about it is Szytel of the Bahnsen Group. Brian, it looks like consumers kept spending last month despite concerns that tariffs might cause higher prices. That was expected to hurt demand. So is this a case of consumers not pulling back their spending or not yet?
Well, we've got full employment in the country, and you can usually count on the U.S. consumer to go out and spend when they have jobs and wages are growing a little bit above inflation. And so the number doesn't shock me. You're seeing some of that flow through to some of the inflation numbers we've gotten over the past 2 weeks as well. But no, I feel pretty confident here on the consumer side. Very strong balance sheets on the consumers, and they're out spending.
How do you think the data jives, let's say, between this report and Thursday's hotter than expected wholesale inflation report?
Those two things can be tethered together. The PPI number that we got was obviously much hotter than we thought it would be. CPI the week before, or a couple of days before, was a little bit weaker. But if you look at what the Fed looks at the most, which is PCE, and you use those two figures to back into that, that didn't move all that much higher. And so I think that's why you still had Fed futures priced in at a 90% chance of a rate cut here in September. So those things will come and go. There can be some volatility around it. Usually PPI is a little more forward looking. You've also seen an increase in M2, which is the money supply, come up here a little bit, which can also be a precursor on inflation. And so those things are something to keep an eye on. But for the most part, you've got employment, you've got a consumer that's spending, as you saw today in retail sales. Generally, that's good for risk assets.
Now, how much of this market strength is predicated on the expectation that the Fed will make an interest rate cut in September and then another one before the year is out?
I think a lot of that's priced in already. And so that's the move up that you've seen. We have gotten a weak employment report last week. You won't have another employment report until September the 5th. And so from now until then, the path of least resistance here is a little higher. That said, you've got a valuation-bound market here where you're just bumping up into some levels on broad indices that are trading at 23+ times earnings. And so that's sort of a give and take there as we go through. But until we get more meaningful data on employment, which is, I think, what the market is paying more attention to at this point, because inflation is now in the rearview mirror, I think the path of least resistance here is a little higher.